Welcome in. On paper, Tesla is one of the biggest winners on the American stock market. Over the 12 months ending in early August 2026, the shares returned about 31% according to finance charts. The company is worth roughly $1.3 trillion per stockanalysis.com as of August 2026. That is more than Toyota, Ford, and General Motors combined, several times over. And yet in the same window, something quieter has been happening. The professional money that usually leads the crowd has, in the last few weeks, started trimming. In the days after Tesla's second quarter report on July 22, 2026, at least 7 research firms cut their price targets according to reporting from Femex and TechEye. Company insiders have sold tens of billions of dollars in stock this year. So we have a genuine split screen, a stock that has climbed over the past year, a set of professionals who are at the margin backing away. This video is about that gap and whether the data actually supports it. Here is how we will do this. Every number you hear comes with a named source and a date, and where the sources disagree, I will tell you. We are not going to predict a price. Nothing here is investment advice. This is an analysis of public data. Markets are genuinely uncertain. Is exactly why the evidence matters more than any single opinion. We will test the headline against the facts in order. First the valuation, then the actual business as of the latest quarter. Then what Wall Street and insiders are really doing, then the bet the price is asking you to make. Finally, what the balance of the evidence signals right now. If the facts break the headline, we follow the facts. Let's start where every argument about Tesla starts, the price. As of the close on August 6, 2026, Tesla traded near $320 a share, per Macrotrends and stockanalysis.com. That is important context the title alone can hide. The stock is up big over a year, but it is down in 2026. Year-to-date it is off roughly 9%, according to YTD return data. It sits about 17% below its record close of $489.88 set on December 16, 2025 per Macrotrends. Now the valuation. Tesla's trailing price-to-earnings ratio was about 270 based on trailing earnings of $1.18 a share per full ratio as of August 6, 2026. Its forward price-to-earnings ratio sits somewhere between roughly 170 and 190 per Guru Focus and valueinvesting.to. Its price-to-sales ratio is about 11 per stockanalysis.com. For comparison, the entire S&P 500 traded at a trailing multiple near 26 and a forward multiple near 20 per Guru Focus and FactSet in early August 2026. Tesla, in other words, is priced at roughly 10 times the market's earnings multiple. To see how unusual that is, look at the companies that make the same physical product. Toyota, the world's largest automaker by volume, traded at a trailing price-to-earnings ratio under 9. With a market value around $212 billion per stockanalysis.com as of August 2026. General Motors carried a forward price-to-earnings ratio near 6.5 and was worth about $76 billion. Ford's forward multiple sat near 8 on a market value around $63 billion. So the market pays single-digit multiples for the legacy car business and a multiple near 170 or more for Tesla. That gap is the whole story in one number. It tells you the market is not valuing Tesla as a carmaker at all. It is valuing it as a bet on artificial intelligence, self-driving robotaxis, humanoid robots, a technology company that happens for now to earn almost all of its money selling cars. Whether that bet pays off is what everything else in this video comes down to. So what is the actual business doing right now? On the top line, it is growing again. Tesla delivered 480,126 vehicles in the second quarter of 2026, up about 25% from a year earlier and up about 34% from the prior quarter, according to Electrex reporting on July 2, 2026. Revenue hit a record $28.24 billion, up 26% year-over-year and ahead of the roughly $25.7 billion analysts expected per CNBC and InsideEVs on July 22, 2026. That is a real recovery in demand. But go one line down and the picture changes sharply. Operating income fell about 57% to roughly $400 million, and the operating margin narrowed to just 1.4% per InsideEVs. Adjusted earnings came in at 33 cents a share, well below the 51 cents Wall Street expected, per Yahoo Finance. Two things drove that. Regulatory credit revenue collapsed to $146 million from $439 million a year earlier. Research and development spending jumped 49% to $2.37 billion as the company poured money into AI robotaxi Optimus. Tesla is selling more cars than ever and keeping less of each dollar than at almost any point in its recent history. There is a second engine that gets less attention, and it is growing. Tesla deployed 13.5 gigawatt-hours of energy storage in the second quarter of 2026, up about 40% from a year earlier per PV Magazine and Energy Storage.news. Energy revenue reached $3.14 billion. But even here the margin story repeated. Energy gross margin fell from about 39.5% to 20.4%. Hit by a warranty charge and the loss of a one-time tariff benefit per Energy Storage.news. And then there is the cash. Tesla still holds more than $43 billion in cash and investments, per its second quarter disclosures reported by KuCoin, a genuine fortress. But for the first time in a while, free cash flow turned negative to about minus $1.1 billion for the quarter, as capital spending surged 142% to $5.8 billion per trading key and KuCoin. The company is spending its lead to build the future it is priced on. Now the heart of the headline: is Wall Street actually selling? The answer is nuanced, and honesty requires the nuance. On the one hand, the average 12-month analyst price target was roughly $390 to $410 in early August 2026. One aggregator citing S&P Global put it near $398 across 47 analysts, and the consensus rating sat between hold and buy. That average target is above the $320 price, which is not what everyone is selling looks like. On the other hand, the direction of travel is unmistakably downward. After the July 22 earnings, UBS cut its target to $385 and moved to neutral, per market beat on July 23. Jefferies trimmed to $350. Wells Fargo held an underweight, its version of sell, with a target of just $130 per market screener. At least 7 firms cut targets on July 24 per Femex. The full range of targets now runs from about $130 to $600 per TechEye, one of the widest spreads on any large stock. So the precise, honest verdict: analysts are not on average calling for a fall, but they are visibly trimming the newest moves lean bearish. The clearer signal is inside the company. Across 2026, Tesla insiders filed hundreds of Form 4 sales. One tally reported by Bitcoin Ethereum News counted 352 sells worth about $41.7 billion against just 11 open market buys, a net of roughly $40 billion sold. Director James Murdoch sold 60,000 shares on January 2, 2026, at about $445 for $26.7 million. But here the data cuts against the simplest version of the story. I will be exact: Elon Musk himself did not dump shares on the open market. In a June 2026 filing, he exercised options for roughly 304 million shares at $23.34, with about 17.5 million shares withheld only to cover taxes and no open market sale per stock titan. In short interest, the crowd betting outright against the stock was low, only about 2.3% of the float per stock near and Fintel. So heavy insider selling by the group, but not by Musk, and short sellers largely absent. The pressure is real, but it is not a stampede. Everything above the car business is what you are actually paying for at a 270 PE, so where does that bet stand? The robotaxi program is real and running. Tesla launched paid rides in Austin in June 2025, removed the safety driver for unsupervised operation in January 2026. By mid-2026 had expanded across the Austin metro and into Dallas and Houston per Tesla Oracle and coverage compiled by Built-In. The purpose-built Cybercab, no steering wheel, no pedals, began continuous production at Giga Texas in April 2026, per Tesla Oracle. The catch is scale. Independent reporting suggested only around 20 robotaxis were actually operating in Austin in mid-2026, a pilot, not a network. Optimus, the humanoid robot, is earlier still. Tesla began converting a California production line for it in the summer of 2026, targeting up to 1 million units a year long-term per the Robot report. These are the engines of the valuation, and as of August 2026, both are at the starting line, not full speed. Let's quantify what would have to be true. The clearest public yardstick is Musk's own pay package Tesla shareholders approved in November 2025, with more than 75% of the vote per NBC News and NPR. To earn the full award worth up to $1 trillion, Musk must, among other milestones, lift Tesla's market value to $8.5 trillion by 2035, sell 12 million vehicles a year, deploy 1 million robotaxis and 1 million humanoid robots. That is the bull case stated by the company itself, roughly a six-fold increase in market value, built not on selling more cars at thin margins, on robotaxi fleets and robots becoming real high-margin businesses. The most bullish analyst targets, near $600 per tech eye, lean on exactly that: autonomy turning into recurring, software-like profit. If it works, today's 270 multiple looks cheap in hindsight. Now the other side in the same concrete terms. The bear case does not need a crash, it needs the AI bet to stay a promise while the car business keeps compressing, and the competition is no longer theoretical. In the second quarter of 2026, China's BYD sold 557,90 fully electric vehicles ahead of Tesla's 480,126, a 16% lead per Palton.org and iTech Post. For the first half of 2026, BYD's 867,479 electric deliveries edged Tesla's 838,149. Tesla is no longer the world's largest maker of electric cars by volume. Pair that with a 1.4% operating margin, negative free cash flow, collapsing regulatory credits. The bear case is simple arithmetic. If robotaxis and robots scale slowly, you are left holding a slower growing, thinner margin car maker priced at roughly 170 times forward earnings, while Toyota trades under 9. Wells Fargo's $130 target is that scenario put into a number. There is one more variable that sits above the spreadsheet. It belongs in the analysis as a fact, not a judgment: Elon Musk himself. His attention is now split across Tesla, SpaceX, XAI, a public political profile. The newly approved pay package ties his personal fortune, potentially the first trillion-dollar compensation deal in history, directly to Tesla, hitting those extreme targets. Two major proxy advisors, ISS and Glass Lewis, recommended voting against it, and Norway's sovereign wealth fund opposed it, per NBC News. For a company whose valuation rests so heavily on one person's roadmap, the concentration of the story in a single, heavily committed founder is itself a variable that professional investors weigh in both directions. So back to the headline, tested against the data. Tesla is rising, true, over a year, up about 31%, not in 2026 so far, where it is down and off its December record. Wall Street just started selling, partly true, worth stating precisely. Analysts' average target still sits above the price. Short sellers are scarce. This is not a wholesale exit. But the freshest evidence does lean that way: a wave of target cuts and downgrades after the July 22 earnings. Roughly $40 billion of insider selling this year, margins at multi-year lows, negative free cash flow, BYD overtaking on volume. The balance of the current evidence then is a real divergence, a valuation that still prices Tesla as an AI and robotics company, resting on businesses that as of August 2026 are pilots. While the metrics you can measure today have softened, the professionals are at the margin stepping back. That is what the data signals. It is not a prediction of where the price goes next. Where this resolves is not on a chart, it is in whether the robotaxi network scales from 20 cars to a real fleet, whether Optimus becomes a product, whether the car margins hold while that happens. Those are things we can measure quarter by quarter with the same primary sources we use today: Tesla's own filings, the delivery numbers, the analyst tape, the Form 4s. We will keep checking the figures against the story, without the hype and without the doom. If you want that plain, sourced numbers first, subscribe, and we will track it together as the next quarter's data comes in.